as part of the Bill Peralta Course 3, I am pleased to begin our introduction of our amazing panel, Access to Capital. These are all the decision makers at their organizations where they have access to capital for small businesses and historically underutilized small businesses. First, we have Julie Klaus, who is a small business administrator, a small business administration director for the region where she oversees for this region, where she oversees delivery of SBA programs and services within 14 counties in Northern California. Julie has worked for the SBA in various capacities as Deputy District Director of the Washington Metropolitan Area District Office, Chief Marketing Outreach Attorney in the Office of General Counsel, and Public Affairs Specialist with the Michigan District Office. And we're happy to have her in San Francisco. Julie has been very instrumental with, many of you may know, the PPP funds that were approved by Congress and the program was allocated through the SBA to local banks and lending institutions. And there's other programs that the SBA has as well that are small business friendly that Julie will give in her overview. Adria Moss is Director of Pacific Community Ventures Loan Fund, where she provides access to capital for historically underrepresented small business owners who have been barred access from traditional financing institutions. Prior to joining PCV, Adria worked in the Financial Services Office at Ernst & Young, where she performed financial statement audits of hedge funds, private equity firms, and venture capital firms as well. Tom, I hope I get your last name right. Tom Dura, I'll get it. You'll help me with that one. I just go by Tom, but it's Thomas, is the CEO of Oakland-based Summit Bank. He is formerly the president and CEO of Sonoma County-based Summit State Bank, during which shareholder return and stock appreciation plus dividends grew by over 150%. That's 5 times the industry average. Tom, like Adria, are both UC Berkeley alumni. And I just give that to all the Bears that are there, that fun fact, because actually I'm a Bruin, but we're all a part of the UC family. Next is Kevin Blackburn. Kevin is the Managing Director of Public Affairs for the Federal Home Loan Bank of San Francisco, a $93 billion wholesale bank serving the liquidity needs of member financial institutions in Arizona, California, and Nevada. In this capacity, Kevin works with members of Congress, state and national trade organizations in banking, and other stakeholders to educate them on the role that the Federal Home Loan Banks play in the mortgage finance, community economic development, and affordable housing development. Prior to joining the bank, Kevin worked as the Northern California Director of Sales for Empower Communications, and was formerly a small business owner for 12 years. So with that, we'll bring all our panelists up live so we can see everybody and start our conversation. We will start the conversation that I will moderate after each panelist gives an overview of their organization and the services that they provide. First up is Julie. Julie, the floor is yours.
All right. Thank you, Shonda. Thank you so much for the invitation to speak with everyone tonight. Hello. I hope everyone's having a great evening. I don't have a whole lot of time with you and a lot of information, so I'm going to jump right in and kind of first introduce you to SBA, because you, while we're largely associated with money and access to capital, there's a lot of other resources we offer as well that you can use in tandem with your quest to access capital and hopefully make you more successful. So real quickly, pretty much everything SBA offers can be placed in one of these 4 buckets. The access to capital, government contracting assistance, business advising and education, and disaster assistance. So obviously the theme this year, unfortunately, has been the disaster assistance. But before we jump into more of that, I'm going to quickly go through the other buckets. So for access to capital, there is more to SBA than PPP loans, although we will talk about those more later. But we do everything. We're meant to kind of be the program that helps you along your pathway as you grow your business. So everything from microfinancing from $50,000 or less, all the way on up through venture capital. And then in the middle, kind of our bread and butter program is our guaranteed loans, which can be up to $5 million. And those are provided through commercial lenders and non-bank lenders. The next bucket is kind of the government contracting assistance, where we do help businesses break into federal contracting through different certification programs. Also, I want to mention it's kind of a contracting program, kind of a financing program. Given this audience, is a surety bond guarantee program. So not very well known, but SBA actually also guarantees surety bonds, bonds offered by local insurance companies for bid performance and payment bonds. So it's a similar in concept to our loan guaranteed program, where we're behind the scenes and we provide that guarantee to the surety in this case. So it's a great program if you're trying to get your first bond, trying to get bigger bonds, and you're struggling to do it on your own. Having that guarantee can really help you. The next bucket is the free business advising. Free confidential one-on-one with a variety of our resource partners across the area, the SBDC, SCORE, Women Business Centers, VBOX, Veteran Business Outreach Centers. This is a great program, free business advising, and it's not just for startups, it's not just for growing businesses, it's for every small business. Someone who can help you. You've all got questions, especially right now when we're really looking to either pivot your business, come up with a new strategy, look for some new lines of revenue. Why not bring in a business advisor that can help you with that? And they try to match your needs with the advisor's expertise. One of the things they're really great at is helping you put your information together, package, if you will, when you do seek financing, whether it's a traditional loan or through some other sources. So I do want to put an extra spotlight on the free business advising as something I strongly recommend businesses consider. But now we'll talk about disaster, because that unfortunately has been our theme. We here in Northern California have had the 1, 2, and maybe 3 punch. COVID, wildfires, horrible air quality, lots of other crazy things happening. So SBA is still actively providing some assistance for the COVID-related issues. So most notably our Economic Injury Disaster Loan Program, or EIDL, which is the one and only place where SBA is doing a direct loan up to $150,000 right now for businesses affected by COVID. This is a working capital loan. It can be used for any business purpose. So there's not the restrictions on it that you found with the PPP. It is meant to help you with whatever you need financial assistance for to support you as you navigate COVID and its effects. For people who may have already had existing SBA debt, any kind, microloan, 7A, 504, any program, we have a debt relief program also going on where we will pay 6 months of your principal and interest on your existing debt. So if you have existing debt and it's in decent standing, you need to talk to your lender to make sure you are enrolled in that program to take advantage of 6 months of payments made by SBA. And then we also have wildfire assistance from wildfires across California, but particularly, we've had quite a few in the Northern California area. So pretty much every wildfire that I can think of now has an active disaster declaration. And again, this is direct assistance from SBA, both in physical loans, if you lost or need to repair a physical structure, your home, your business, anything. We help everybody in that instance. The loans are to cover uninsured losses. And we also have the economic injury disaster loan with that as well for businesses. This is for small businesses and nonprofits who have been maybe not directly impacted by the fire in the sense that their property was not damaged, but they certainly may have had an economic impact because maybe you had to close down your business, maybe the roads leading to and from your business maybe were closed and you couldn't get supplies or your deliveries. But the other thing that I want businesses to consider, and this impacts a lot of people, is the fact that there was such horrible air quality for such an extended period of time. If you were a business that was forced to operate outdoors because of COVID, and now you had the ash and the horrible air quality to deal with that maybe couldn't allow you to operate outside, you might be able to qualify for disaster assistance from SBA under both COVID and wildfire. So I just throw that out there as a means to consider if you've had some financial impact in that way. Let's jump into the next slides, and we're going to pivot to talk about PPP. We could probably spend the next hour talking about PPP and the forgiveness aspect, but I'm going to go through this really quickly, and then I'll let you know with some other resources you can consult with if you have more questions or really specific questions. So the PPP loans, pretty much everybody is in a phase now of either spending down their money, or maybe you have spent down all your money and you're really looking at forgiveness now. So just a quick reminder, what is forgivable in the PPP loans? So the benchmark you wanted to keep in your mind was a 60-40 split. You wanted to spend at least 60% of those loan proceeds on payroll costs. And payroll costs includes not just the compensation you might pay yourself and your employees, but it can also include in benefits programs. For example, health insurance, your employer premiums that you're paying on behalf of your employees. It can include leave that you paid out, include retirement plans, any benefit program you offer. It also can cover state and local taxes that are assessed on employee compensation. So all of those things add up to at least 60% of your loan proceeds. The other 40%, or not to exceed 40%, is the non-payroll costs. And again, this bucket is a little bit more narrow. These are things like mortgage interest, rent, or utilities. And I know there's a lot of question on what kind of utilities can be included. It's really, as you see on the screen, the basic utilities. Transportation is one that is, I get a lot of questions about. So, can cover gas if you have fleet vehicles or something and you have to pay gas to go out and service. It can potentially include, it could potentially include tolls or things like that. I would really ask your lender, if you have a long list of things that fall under what you think is transportation, it's really good to ask your lender if that's their interpretation of it as well, or what they will consider. Because when we get to the next slide and talk about the process, you will see that the lender is a very, very important piece of this equation. So forgiveness is open, if you will, available for anybody to apply for as soon as you've basically spent all the money. So either your covered period has ended, the 8 weeks or the 24 weeks, or if you're in the 24 weeks, but say you hit week 15 and you've actually spent all of the PPP funds, you can go ahead and apply for forgiveness at that point if you would like. So the real litmus test is obviously that you've just spent all of the money. What you're going to do is fill out the application, and we'll talk a little bit more about those in a second. You're going to submit that application to the lender, and do check with your lender, because some lenders have tried to automate the process and they might want you to go onto their website and fill out an electronic version of the form. Others may be accepting paper copies. So I would just double check with your lender which version they are utilizing. You're going to complete the relevant application, and you may, this is a may, submit additional documentation depending on what the lender asks for. So as a recipient of PPP loans funds, I would definitely document everything and keep all of that documentation. This includes not only what was probably obvious, but payroll and utilities and other benefit costs you might have either incurred or paid out during your covered period, but also things that relate to the hiring, retaining, or trying to bring back your employees. Specifically, emails or other written correspondence you may have had with your employees. If you were trying to bring them back, and maybe some of them decided they weren't going to come back for any number of reasons, that, you know, any sort of written communication verifying that you did make the offer to them and they did decline. If you did that verbally, I would then recommend that you do like a memo to the file or some sort of written memorial that documents that's on such and such a date. I offered, you know, Jane Doe her job back at, you know, her regular salary, normal hours. She declined the offer, etc. And then any other documentation that might relate to healthcare issues or health department regulations in your area that have impacted your ability to operate. These are usually found on websites, and health departments have been updating their websites on a regular basis as things change and evolve. And because these websites change for your period, your covered period, I do recommend businesses either take a screenshot or download or somehow archive what your health department said that affected your operations during, you know, your covered period of the loan. This is all things you should gather and keep, regardless of whether or not the bank actually asks you to produce them, but keep this as your supporting documentation. You will submit your application to the lender. The lender has up to 60 days to review. The lender is going to actually make the decision on whether or not to apply forgiveness, basically, and in what percentage as possible. So some people might have 100% forgiveness. Some people may have a portion of their loan forgiven. There's a number of factors that go into that, including the most obvious, I hope. Did you spend the money in the manner you were supposed to? Did you spend it on the things that were allowed under PPP? If you've seen the news reports, you know, some people have chosen to get a PPP loan and spend it on things like, you know, Rolexes. So that they will not have their loan forgiven. But if you have done your best efforts to have to spend the money in accordance with what it was intended for, chances are you will have your loan forgiven. The lender then will do that process. The lender will actually submit everything to SBA. There's a specialized portal for these lenders to utilize. The lender will submit. SBA then has 90 days to review and to actually pay the lender the forgiveness amount. Anything that is not forgiven will, at that point in time, this is after SBA remits payment to the lender, the rest of it, if there's an unforgiven portion, will be converted into a term loan at the 1% rate, and either a 2-year or 5-year term, depending on when you originally got your PPP loan. So the next slide, I have just an outline of the form. So I talked about the different forms, and in case you hadn't heard, there's actually a third option now. So there's 3 different forms so that you may qualify for, depending on what your circumstances may be. So option 1 to look at is this 3508S form. This is the newest one, and this is if you have a loan of $50,000 or less. This is the form for you. It is 1 page, essentially. You don't even have to do any calculations on the actual form. You do calculations offline saying, this is how much I got, this is how much I spent X amount on payroll, I spent X amount on my non-payroll costs, and you do a self-certification and send it in. Very streamlined. Option 2 is the easy form. In order to be eligible for this form, you either have to be a self-employed person with no employees, or if you have employees and basically the circumstances have not changed, meaning you haven't reduced your number of FTEs by more than 25%, or you haven't reduced pay significantly, and you are able to operate at your pre-February 15th, pre-COVID operating levels, this is the form that you might want to consider. If you have a safe harbor that applies, meaning some of the safe harbors were offering your employees their job back and they refused and you weren't able to replace them, that's kind of one of the safe harbor rules. The other is the inability to return to your pre-COVID operating levels because of healthcare department regulations or other COVID-related reasons. So basically, the easy way to think about the easy form is if your circumstances haven't changed significantly or go above and beyond what the safe harbor provisions allow. For everybody else, there's the regular form, the 3508. So if you don't fit into option one, if your loan wasn't 50,000 or less, if you have, and option two doesn't work for you, meaning you might have significant changes to your payroll or your employees or other issues, or if you just had a very large loan, you will probably be utilizing option three, the form 3508, which is lengthier and does include several worksheets and calculations that you do need to provide as part of that forgiveness process. So I know I'm butting up against my time, so if we just go into the last slide, I have some resources for you all, and this is ways to reach us in the district office, where you can find more detailed information on PPP forgiveness and the applications I just talked about on our website. And then also there's webinars that we hold. So if you want to, spend an hour and take a deeper dive and walk through, especially the EASY or the forgiveness applications forms, we do have webinars available to help you do that as well. So I know there's a lot of information, but thank you, Shonda.
Thank you. That's what we're here for. We want all that information. Next up is Adria Moss for the Pacific Community Ventures.
Hi there. Again, my name is Adria Moss, and I'm the Director of Lending at Pacific Community Ventures. Super excited to be with you all this evening and hope you all are doing well. Pacific Community Ventures is a nonprofit that has been around for about 22 years now, and we're located in Oakland, previously in San Francisco, but we made the move over intentionally to the East Bay about 2 years ago. We are a part of an industry that is known as Community Development Financial Institutions, so also known as CDFIs. CDFIs were created in 1994 under the Clinton administration when the government realized that not enough capital was going to small Main Street businesses. So there are actually over 1,200 CDFIs nationwide doing mission-oriented work. So Pacific Community Ventures itself is a nonprofit that engages small businesses, investors, and policymakers to create good jobs for working people and build an economy that works for everyone. The businesses that we work with are mostly owned by women. They're mostly owned by people of color. They're experiencing higher job growth rates than the industry averages, offering higher wages as well. So if we go on to the next slide, I'll dive a little bit deeper into our programs. The first program that we offer is small business lending. We offer loans between $10,000 and $200,000 to growth stage businesses within the state of California. So when I mean growth stage, I'm talking about businesses who have been in operations at least 9 months, maybe 6 months. We can be a little bit flexible and are looking to grow and expand. Obviously, that is changing with COVID, but we're still looking for people who have been in business. We are a non-SBA lender, so that means that we are a bit more flexible, and we're working with a lot of businesses who have been turned down by banks, who have been turned down by the SBA, maybe did not receive that PPP funding that they were looking for. And we are intentional in doing that in a few different ways. First, we're personal, so we get to know each and every borrower. We hop on the phone with them. We're learning about their dreams. We're learning about their struggles. We're learning how we can fit into their vision and make sure that they're reaching their goals. We don't have a minimum credit score. So if people have faced bankruptcy or are behind in perhaps student debt or medical bills, we just need to know what's going on. Again, getting to know our customer is really important to us. And so that also allows us to work with recent immigrants. So if you have an I-10 but not a social security number, we can still work with you. And what I'm really excited about is over the past 3 years, we've created a social impact underwriting tool. So in addition to looking at the financial ratios of a business, we're also looking at the social impact that a business creates. So of course, whether that business owner is a woman, a person of color, perhaps LGBTQ, formerly incarcerated, but really, what are they doing for the community? So are they hiring from the local community? Are they hiring from low to moderate income areas? Are they offering quality jobs? So are they offering a 401k, perhaps profit sharing? Are they providing fair and stable schedules? So we're really looking at the business in a holistic manner, which means that if a business comes to me and perhaps does not score, quote unquote, as well as I would have liked them to score on the financial side, but are scoring very well on the social impact side, I can still make that loan, which has allowed us to take more risk. And in the long run, we'll even out. The loans that we offer are used for a variety of different reasons. A lot of it is used for working capital, hiring employees, moving to new locations. In this case, in this current environment, keeping employees, maintaining their lease, really working to keep businesses open right now. In 2019, 80% of our capital deployed went to women or entrepreneurs of color. 61% of loans were women alone, and 58 went to business owners of color. I am excited to say that in 2020, we're exceeding all of those numbers. So as of this month, 90% of all loans made this year have gone to people of color. Over 60% have gone to women, and 95% have gone to businesses located in or hiring from low to moderate income areas. So we're very intentional about the businesses that we work with and really excited to be in the community. If we go on to the next slide, I'm outlining the different process that we have created as we have seen COVID really hit the small businesses within the country and in the state of California. So previously, and this does get into the numbers, so stick with me here and also reach out if you have any questions. We're working with the state to get guarantees on all of our loans. And previously that was an 80% guarantee, meaning that if the loan goes bad, then the state is paying us 80% of the principal. We were looking for 3 years of business taxes, 3 years of personal taxes if available, year-to-date financial statements, a personal financial statement, a credit report, a credit memo. And the approval was rather quick, but not as quick as we would like it to be. Several days up to a week for if we have everything that we needed. And key here was we were looking for a debt service coverage ratio of 1.25 to 1, meaning if you have $100 in debt every month, we wanted to see $125 of income coming in to make sure that you were able to pay that debt. With COVID, we have rapidly changed our program. So we are now working with the state to offer what is known as the Disaster Relief Program. You can learn more at ibank.gov. That's ibank.gov. And we are offering 95% guarantees. And these turnarounds are happening within 24 hours if we get all of the information we need. So we are now looking just for a debt service coverage ratio of 1 to 1. So $100 in, $100 out, just making sure that we can make those payments. Last year's business taxes or financial statements, we don't need both, and we don't need year-to-date numbers because we know that business owners have a lot else on their plate. So if we can just see last year's numbers showing that you made a profit, we can work with that. We're looking at bank statements for the most recent 3 months, and we're still pulling credit. As a reminder, there's no minimum credit score, but we're still pulling that. And again, approval within 24 hours, up to $50,000, up to $200,000 takes a little bit longer, but we're really doing our best to respond to community needs. I should also add that almost none of our loans are collateral based. With the racial wealth gap, with the history of everything that has occurred in this country, we know that there is a gap. And so we're not requiring any assets per se that a typical bank would be looking to collateralize on the loan. And next slide is about our business advising program. So in addition to the loans that we also offer a small business advising program. And please note that you don't have to be a borrower with us to access the business advising program. This is a pro bono option for anybody in the United States. So whereas our lending is for California, business advising is nationwide. A fun fact that I like to share, or maybe it's called a not so fun fact, of only 30% of businesses make it to the 10-year mark. But for small business owners with a mentor, 70% of small businesses reach that 10-year mark. So there is an access to capital gap, but there's also an access to knowledge networks that there's a gap. So filling this knowledge network is really what we've seen to be key as we expand the small business success in the nation. So we have a pool of over 1,000 mentors nationwide in various areas of expertise, whether that be financial, legal, marketing, HR, et cetera, who offer their time for free. And how the process works is a small business owner will go online and fill out a profile, tell us what help they're looking for. And a small business advisor does the same thing and tell us what they can offer. And then we go ahead and match them after having conversations with them. So we like to say it's kind of like a match.com per se, except for small business owners and advisors. And we've seen really great success with this. There is an average increase in revenue of 20%. And job growth is 7 times the national rate. So again, that access to knowledge networks is key, and it's a free resource. You can go to businessadvising.org or pacificcommunityventures.org. And the last slide is just my contact information and some amazing entrepreneurs that we have worked with over the years, local businesses that many of you may know, Red Door Catering, Boba Guys, Court Smith Basketball Industries, Hobbies and Empanadas, Taylor Jake Collection, Bread Seriously, and the list goes on. So I'm inspired every day by the resilience and the passion that these small business owners have, and we're here to help support as much as we can do. So please feel free to contact me via email. I'll get back to you as soon as we can. So thank you so much for having me.
Thank you. Tom from Summit Bank. Oh, I think you're still on mute.
Okay, how's that?
Right. And one fun fact from Summit Bank, is this still true? I know when the PPP funds first, not the second round came out, that Summit had reported that everyone that packages that they submitted actually got approved by the SBA.
Correct. We had 144 applicants and 144 got approved. So yeah, it's really good. So just give you a little background on Summit Bank. So first of all, we are a community bank, and I want to make that distinction. The bank was founded by Shirley Nelson back in 1982. And the reason she started the bank was she worked at a bank across the street. We're located, our world headquarters is at 30th and Broadway. And she worked for a bank, I forget the name of the bank, but she had been a very top producer, and she made an appointment to meet with her CEO to see if she could become a vice president and also to get a raise because she really was a top producer. And the CEO, now remember, this is the late 70s, early 80s. The CEO looked at her and he said, well, first of all, I would never give a woman a vice president position, number one. And number two, if you really want to raise, why don't you go talk to the bank across the street? Well, there wasn't a bank across the street. And she got so ticked off that she said, I'm going to start a bank. So she went to her clients and they said, Shirley, you don't know how to start a bank. And she said, you know what, I'll learn. And she raised about $3 million, which was still quite a bit of money, but back then especially so. And the bank has been profitable since the second month that we've been in existence. We're celebrating 38 years. And we have branches, our headquarters in Oakland, Emeryville, and also Walnut Creek. And and I want to really emphasize the community bank, when you get a license to become a community bank in California, it says in your charter to do for the greater good of community. And the way that we do that is we bring in local deposits and we lend it back out. So 100% of all of our loans have been funded with local deposits, and we're very proud of that. Not so much due to me, but the bank has consistently been a very top performing bank throughout California. We are a commercial business-focused bank. We really don't do consumer stuff. We might do an overdraft line or something, but it's much more commercial focused. That includes commercial working lines of credit. They can be, you can also get a permanent working capital as well as equipment loans, commercial real estate, both conventional. We do SBA 504 loans too, which is a loan where the applicant only has to come up with 10%, and the bank provides 50%, and then the SBA through what they call a debenture, they sell that piece in the marketplace for the 40%. So it's a really good program, and it's especially good because the rates are especially attractive. But that's helped a lot of businesses to not only help their main business, but also to build equity in a property. And as we know, property values in the Bay Area go up. And we also do a fair bit of construction, 1 to 4 units, some commercial as well, office, industrial, some multifam too, which would be apartment houses. We're also very active with the California State Guarantee Program, which is similar to the SBA in that, keep in mind that with a commercial bank, because we're regulated by the FDIC, which provides the insurance on our deposits, they want to make sure that we have a primary source of repayment, a secondary, which primary would be, do you have the cash flow? Secondary would be, do you have the collateral? And then what's called tertiary, or third source of repayment, which would be the personal guarantee. And so many times, and I think our 2 speakers before spoke about this, maybe they don't have strong collateral or they don't have the guarantor support. So these state programs and also the SBA, they can come in and help these businesses get the loans. We've also recently become more active in exploring different ways that we can help even more people in our community. And so I've recently spoken with a woman who heads up a group in San Francisco called Investment in Women's Initiative Entrepreneur Program. And we're seeking out other programs like this. So I heard some of the speakers earlier, and that really fits with what we're doing. So I think that gives you a little background of who we are, Summit Bank.
Thank you, Tom. Kevin?
Good evening, everyone. Hope you all are doing well. Thank you very much, Shonda, for the opportunity to participate in this. And my job is fairly easy tonight because all 3 of the previous speakers, beginning with Julie from the SBA and Adria from Pacific Community Ventures, and now Tom from Summit Bank, are all interrelated in one manner or another with the Federal Home Loan Bank. So let me give you a little context. And before I start, let me say that I am not a bear, nor am I a Bruin, but I am a product of the Peralta Community College District. I'm actually a Don, okay? But I got my start in college at the Peralta Community College District, so I'm glad to be participating tonight. The Federal Home Loan Bank's system, something that most people don't know much about unless you're in banking, because our siblings are much better known than we are, and that would be Fannie Mae and Freddie Mac. But we were created, chartered in 1932 following the Depression, to help the economy recover and provide a funding source and a source of liquidity for mortgage lenders. So kind of very much in a situation like we are today, the Congress passed the CARES Act and the 3, at this point, 3 COVID packages. The 4th one is in the mix, but we were a part of the response to the Depression. And our name is a little bit of a misnomer. We're not federal. We don't originate home loans, and we're not a bank in the traditional sense. We are a liquidity facility, and we're a cooperative. So we are a tool that lending institutions use to finance both housing, multifamily housing, and economic development loans in their communities. And the Summit Bank is a member of the Federal Home Loan Bank of San Francisco. And so when Tom, as an example, has provided funding for commercial properties and for multifamily properties and for businesses, and he's out of cash, let me just say it that way, and he may need some additional liquidity. He may need to turn some of the loans that he has originated into cash so he can do more lending in the community. He would pledge those loans to us. We would give him in exchange for that pledge then access to more funding that he could then deploy throughout the community. So there are 11 banks nationwide, and we do have a regulator, the Federal Housing Finance Agency, which is the same agency that regulates Fannie Mae and Freddie Mac. So next slide, please. Now, as I mentioned, we're owned by financial institutions that are headquartered in Arizona, California, and Nevada. And the majority of them are depository institutions, commercial banks, community banks, savings institutions, credit unions, and insurance companies. And then we also have community development financial institutions as members. It just so happens that although Pacific Community Ventures is not a member of the Federal Home Loan Bank of San Francisco, in 2018, we did provide a grant to Community Pacific Ventures through our Quality Jobs Fund to the tune of $3.2 million for the purpose of helping them fund businesses that are creating quality jobs. And then probably the thing that the bank is known for the most in the broader community is our affordable housing program. And 10% of our earnings annually go to support the affordable housing program. And so what does that mean in Oakland, for example, or at least in the 13th Congressional District, which includes Berkeley and San Leandro and parts of Hayward? We've provided over $40 million in affordable housing program grant money to affordable housing developers that have created a little over 4,500 units of quality affordable housing right here in Oakland and surrounding areas. So that's a little bit of a background about who we are and what we do. Now, what is the connection with you as either an existing business owner or a new business owner trying to grow your business? Well, if you could go to the next slide, please, Shonda, or whoever's controlling that. Thank you. So in addition to the loans that we provide to our member institutions when they pledge collateral, and we call that an advance, we also have some very specific programs that allow our member institutions to provide discounted rates to small businesses for loans that support housing, economic development, and small businesses that are creating jobs. So how does that play out? Specifically for most of you as it relates to the Peralta Build project, there is an ACE advance. And the ACE advances are a discounted product that we provide to our members to support SBA 7A lending and small business lending. And so what does that really mean? It means that our member institutions are able, if they choose to take advantage of the product, and we offer a variety of products, and it's kind of like a buffet. You know, if you go down a buffet and you don't like beets, then you're not going to take the beets. Well, in this case, if a business is working, one of our member institutions is working closely with small businesses, they may choose to take advantage of our ACE advance, which gives them the ability to offer a lower rate that, could be up to 10 basis points lower. And when you're a business, those basis points begin to make a big difference in your cash flow, and that's significant. So how do you access those programs? Well, you have to build, you're building Peralta right now, and that's the whole purpose of this call, is to build Peralta. But I'll leave you with 3 takeaways. Is one, you have to build relationships with a banker. And if it's not a banker in the case of Tom at Summit Bank, then it may be a CDFI in the case of Adria with Community Pacific Ventures. But the important thing is to develop that relationship, because as they understand your business and as they understand your cash flow, what the Federal Home Loan Bank provides is the ability for them to make decisions that may not necessarily fit in a box that a standard underwriting criteria would fix, because they're able to pledge those loans to us. So it gives our member institutions flexibility. It also, frankly, gives small businesses a little more flexibility. The important thing, though, is building that relationship. And so you may start off with Adria, and one of her loans from 10,000 to I think she said 200,000 to get your business going. And you can, if you do that and you do that well, as you build capacity, which is the second key point, as you're building capacity and growing your business, you're doing that in concert with a banker who becomes really a consultant for you, whether it's a traditional banker like Tom or a CDFI, as in the case of Adria. They become a part of your team that is going to help you. But the only way that they can help you is if you build solid accounting practices. Because Tom mentioned earlier that 140 applications, 140 PPP loans. Well, you had to come to those applications with some financials, and you had to be able to present those financials in a way that not only met the application criteria, but that the banker can understand. What's so important about that is something that is kind of colloquial, and that is, if you stay ready, you'll be ready. Okay, you can't wait until you want to go get a loan and then put your financials together. You have to have the accounting practices in place that allow you to produce your month-end reporting every single month, so that you're on top of your business. Because as a business person, if your outgo exceeds your income, it's the upstart of your downfall. Now, do I need to say that again? If your outgo exceeds your income, it is the upstart of your downfall. In other words, you have to be able to make more money than you're spending through your business activity. And so my encouragement for you is that the home loan bank is a tool that banks use. We operate really behind the scenes. We don't do direct lending. We don't grant individuals. We grant nonprofit organizations. Most of them are affordable housing developers. And we've given over $1 billion away in those grants for affordable housing. But our work is behind the scenes to allow the banks to have the liquidity that they need, or banks and credit unions and CDFIs, to be able to provide the lending to startup businesses, to existing businesses, to commercial developers, to apartment building buyers. And so that is the role that we play. But we also, in that, we walk alongside our member institutions, just as I'm asking you to find a banking relationship to walk alongside with you as you grow your business. And so with that, Shonda, that's a little bit about the Federal Home Loan Bank of San Francisco and the work that we do. And I thank you for the opportunity to participate tonight.
Okay, great. So now we will have our live discussion with the panel. I have a few questions, but then I see our audience has several questions that have come in. So Julie, are you back up? You're there you are. Okay, and you all can unmute now, because we'll just have a conversation. We wanted to have this session, one, because it was one of the top ranking courses that our poll told us that the small businesses were interested in, but also that we know that access to capital is one of the main hurdles for small businesses, especially historically underrepresented businesses. So with that, if a business is interested in growing and going to the next level, what are some of the main challenges that you find that small businesses have when they're at that point, and what can they do to be prepared to go to the next level?
So is that for me or for any of us?
Everybody, but you can start. Okay. Thank you.
I almost feel like, oh, sorry, it might get a little noisy here. That the answer might vary a little pre-COVID and COVID world, but I think preparation is never going to change. That's always something that's really important. And I would say take advantage of the technical assistance, the free business advising that's out there from SBA and other resources, because they can help you figure out, you say, this is where I want to be, whether it's additional financing, whether it's another kind of business goal you have, an objective, and let them sit down with you and say, okay, that's where you want to be. Let's find that path forward. If you're going for financing, we need to package you up, right? And make sure that you've got all your I's dotted and T's crossed and that you're ready and you've got good solid projections. Right now in this environment, people keep asking me, can I get a, more traditional loan? The answer is yes, but credit is getting tighter. And I'll let, some of maybe Tom or somebody address some of those from the lender's perspective as well. But I think getting some help to help you figure out exactly what your path is going to be and trying to find the right resources to get you there.
I'll just add that, many times a company will come and they want to grow, and, it's so important for a company to have good capital built up in the company. And you build up the capital through your original investment and then, of course, by your retained earnings. So when a company comes to us, we want to make sure that we want them to succeed, but we don't want people to get over levered where they've over borrowed. So a bank will be a bit more conservative in that regard, and simply because we're regulated by the FDIC. It's important to keep in mind that the money that we're lending is not our money. It's our depositors' money. And if you are a customer of the bank, it's your money. So the FDIC wants to make sure that they tap their insurance fund. So they want to make sure that we do it to Hoyle, if you will. They want to make sure that we're doing it the right way, in a prudent way. I won't use the word conservative, I'll say prudent way. So that's a really important thing for businesses to realize. And Kevin talked about it to a certain extent, that you make money, well, you want to retain some of that money so that can help you. Capital is there to help you grow, and also if things turn against you, to help you absorb some of those losses. Hopefully, it will be a short-term loss. So I would really encourage people to retain capital, to build your capital, so that when you do want to grow, you have the base with which to grow.
I like both of those, and I completely agree. In addition to the relationship building, Kevin, that you mentioned, I would also add doing your homework is really important. So really knowing your needs. I offer up to $200,000, and people will come in and say, well, I want the most, right? I want $200,000, but that's really not what they need. They need a particular amount, maybe $75,000 to help with payroll or get that equipment. So going into an institution and really understanding what you can take on and what you really need to grow the business is a big part of it. And as you go to any lender, if it's a CDFI or if it's a bank or if it's the SBA, you'll need your documents in order, even during COVID. And I know that's a hard ask right now, and it's not wonderful to say, but have your taxes ready because they're going to ask for them. Have any financial statements ready that you can, because they're going to be asked. So if you have a package complete, you can really just hand them off to lenders as you go through the system.
I would just add that, am I unmuted?
Yep, you're good. We can hear you.
Yeah, I would add that it's important for business people to understand the role of a CDFI or a bank, a lender. They're in the business of managing risk. And so when you come to them and say, oh, I'd like to borrow $75,000 for new equipment, it's no different than going to a bank and saying, I'd like to buy a house. And, can you afford the house that you want to buy, right? Do you have the cash flow and the assets to put a down payment? How are you managing your business so that the risk that the bank takes when they lend you $75,000 or the CDFI takes, that they have a reasonable assurance that you are going to be able to pay them back for that? Right. And Tom spoke to it. That's why they need capital. That's why it's important. And that's why banks have capital, so they can absorb the losses if things don't go the way that you plan. But their underwriting, when they walk through you with your business plan, when they look at your financials, when they understand your cash flow, whether you're manufacturing or whether you are providing a service or whether you're a distributor, whatever the case may be, they have to have a reasonable assurance that you're going to be able to pay that back. So you maintaining solid financials and good records makes it easier for you to tell your story, and then for them to be able to understand the story and make a determination. You know, maybe it's not 75,000, maybe they can only give you 50,000, right? But if you have those things in place, they're going to be an honest broker with you because they're in business too. And just like you're in business to make money, banks are in business to make money, and they have to be very prudent in the way that they manage their lending to ensure that they remain in business as well. And so if you just look at it from their perspective, you know, get all your ducks lined up, your I's dotted and T's crossed, it definitely makes it much easier to get a loan in a reasonable amount of time, and a loan that you can afford that's not going to put you out of business.
I know people always say, look for funding when you don't need it. And that was fine before COVID hit. But now post COVID-19, I mean, how do you see that the industry is going to change, meaning the lending industry? And it was hard for small firms, especially historically underutilized firms, to get access to capital during, you know, good times. So how is it going to change for, you know, sole proprietorships and, you know, small business owners now that we have had this COVID, you know, post-COVID life, and what can firms do to prepare for the next pivot? Now, Julie, you can probably hit this first too, because you would have a lot of the intel because of what's going on with Congress and, you know, how that's kind of impacting the lending industry.
Yeah. Well, I can't predict what's going on with Congress, but yeah. There may be, you know, I'm sure there's going to be another round of economic stimulus funding. What exactly is going to be in that bill, and what it's going to look like is still kind of really up in the air. Obviously, there's a lot of different things being debated. So aside from that, though, I mean, history has shown, you know, we've never weathered a pandemic, but we have weathered economic downturns before. And when the economy, you know, dips or takes a nosedive, we do see banks leveraging SBA's guarantee programs much more significantly. So we become more active when the economy is maybe not performing the way everyone would like. So, but then there's this added layer, right? We've got this layer of uncertainty about the future because of this pandemic and how we're going to be able to recover, and how businesses can get back to a normal revenue stream. So it does add an extra layer of complication when you're looking at projections and on, you know, your basic financials and paperwork. I mean, everybody's financials from this year are going to look horrible, right? Unless you're a toilet paper manufacturer, yours probably look fantastic. But so it's how do we manage that? And then, you know, working with our lending partners, we were so fast and furious to get the PPP money out the door that now I think it's the time to like, okay, what's next? And one of the things I'm trying to do is talk to some of our commercial lenders and some of our nonprofit lenders and say, what are you feeling? Like, what is your appetite to do lending? Like, what are you looking at over the next 6, 12, 18, you know, 24 months, so that we can get a better sense of what the banking community is looking to do, and then we can, you know, help the small businesses better position themselves and steer them towards the resources that we think are a good match for them, given whatever their financial needs are.
Okay. Tom, do you have any intel for us on the banking outlook?
Yeah, you know, this downturn, COVID related, is much different than it was in 2008, 2009, 2010, which seemed to be across the board people were hurting. Whereas now, I can't go out and see my clients now, so I just call people. Every day I call people just to check in, how you doing? And I would say six or 7 out of 10 are saying, doing really well. But in this environment right now, where anything related to most retail, or hospitality, travel. That's, I mean, they're just taking, you know, really taking the short. Other companies are doing as well. So it's on the company that's coming to you. But I will say this, that you have to look at pre-COVID financials, and to a certain extent, your first reaction is, okay, I got to discount that. But then, as I said, there are certain companies that have just continued on doing well. I was talking with one of our board members who's out in Walnut Creek, and he's a property manager. And he said, Tom, the percentage of people not paying is like 2%. Whereas I live in Berkeley, and I'm in a 9 I'm on the top floor, there's 10 units, there's only 2 units, there's only 2 being occupied. There's at least 30% vacancy in this building. So it really kind of depends on the type of business and where that business is located as well. So not just like I said before, it was across the board, everybody was hurting. So you have to keep that in mind. It's really by industry.
Okay. Kevin and Adria, did you want to add to it? Because otherwise we have some questions from the audience that I wanted to take, because our time is getting short. There's so much information in such little time. Did you have anything to add to it?
Yeah, I would add that in 2007, 2008, you know, it was a different crisis, and the federal government didn't respond. There were lessons learned. Mm-hmm. And they didn't respond in 2007, 2008 the way that they did with COVID-19. So in terms of the Federal Home Loan Bank's role, we put $320 or so billion into the financial system in 2007, 2008 without any special dispensation from Congress. It's just the way that the system is designed to work as a counter-cyclical tool for the economy. Fast forward to March, we put in about $120 billion. And then the Federal Reserve came in and they created all of their lending facilities, and they were able to absorb kind of the shock. And then we saw our, you know, advanced volumes go down because the Federal Reserve came in. So there are gears and levers that were utilized this time that were not utilized in 2007, 2008, which I think has helped to smooth out the adverse effects of the pandemic. But it's not over yet, right? And so, you know, our role is to be there in times of economic stress for our member institutions, so they can still have the funds necessary to lend. And I, you know, we will be there for that. So I think that it's, there were, you know, it was so close between, I mean, relatively speaking, right? In terms of economic cycles, 2007, 2008, you know, 12 years ago, the lessons that were learned are actually being able to be implemented this time without the loss of the historical, you know, memory that happens when it occurs over a generation, you know, or there's 20 or 30 years between it. So I think that the government has done a good job, but they know that they need to do more. And once we get beyond this election, I think you will see some additional support coming from the federal government through Congress.
Okay. We have Ed Dillard Ram has a question. He has his hand raised. Ed, are you on mute?
Shonda, can you hear me?
Yeah, we can hear you. What's your question?
Yeah, thank you. My question is for Tom Dryas.
Dury.
Dury, Tom Dury.
Just think, yay!
Oh, Dury.
Duryea.
Duryea. Okay, thank you very much. We're in a different environment now, and I work with a lot of minority contractors, and they need to have access to capital that's not traditional capital. And they have contracts that they need to have funded, and we need to be able to work with you to design a program so that when they do get contracts, that they can use some working capital a line of credit based on the value of the contract that they have, so they don't have to use personal property as collateral. They can use the value of the contract and maybe set up a repayment mechanism where the prime contractor does a three-party check so you can make sure you get your return. And I'd like to work with you on such a program.
Let me give you my telephone number.
Please.
My direct line is 510
510
267
267
1028.
1028. See, that type of system helps the prime contractor, it helps the subcontractor, and it helps the bank. So that's a win-win for everybody. And I appreciate your willingness to discuss it.
Don't forget it helps the community too.
Right.
Absolutely. It creates jobs. It creates opportunities for tax base increase. It creates opportunities for completion successful of projects. Thank you very much. I will contact you.
Sure. Look forward to it. Thank you.
Thank you.
And Tom, Bonnie, James, and I are working on a small business plan that would be part of some of the options that we're recommending. So we should all like circle together and talk about how that will look and how that can be implemented possibly at Peralta's bond program.
I'd like to have that conversation, Shonda.
Okay. Sounds good.
Shonda, I would just ask Adria, is that something that you guys are currently doing, anything like that?
Yeah, I was thinking we don't do that particular program, but we have lent to construction companies and consultants that have contracts out and been able to do loans that way. Yeah.
What's the largest size you provide for those programs?
I mean, same program, so up to 200.
Okay, so 200,000 is always the cap.
It is.
Okay. For funding for such that program, would you have like $1 million, $14 million fund, and then from that you pull $200,000 loans for projects? How large is your fund again, Adrian?
We've made $14 million in funds in loans. Outstanding right now is $7 million.
Okay. We have a few other, Fred Powell, did you want to ask your question live? Because you had a few questions as well for Julie. Is Fred on mute, Fred? Okay.
Julie has answered one of my questions.
Okay.
And hello, by the way, Kevin.
Good evening, Fred.
The other question I had for Julie is, we received a PPP loan, and my question is, what happens if the payments on that loan are slightly over the loan amount? Because we can't make it fit exactly in terms of, payroll versus, if it's 60% payroll and 40% other costs like rent and utilities, we can't reach that exact number. So if we're a couple $100 in terms of payroll over what we've paid out because we went into another loan source to make that payroll or to make those utilities, and we submit that to you guys, what happens? Does the SBA approve that? Or are we going to be denied because we've overpaid?
Well, I mean, you can only be forgiven up to the loan amount. So, you have lots of expenses, and everything, over a period of time is probably going to be greater than the amount of your PPP loan. So it's up for you to decide how you want to allocate those funds. People can do 100% payroll if that's what they choose. Or they can, maximize those other expenses and go up to 40% of those. You might end up, prorating. So let's say you had an 8-week covered period, and if you added up all the payroll and eligible non-payroll expenses for that 8 weeks, and it exceeds the amount of your PPP loan, that's okay. You're only gonna be able to claim up to the amount of the PPP loan. Just make sure that the absolute numbers you're claiming fit that 60-40 split at a minimum.
Okay.
But you might not get to pay all of your rent because you might not have had enough money in your loan, or it would be exceeding the 40%. So you might pay a portion of rent, for example. If that makes sense. Did I help you answer your question?
Well, yeah, I think you understood it, but in both cases, we're a little over the 60-40% because we cannot math. If you do the math on a $95,000 loan, if you do the math, it comes out to a certain number, right? And our payroll and rent and utilities does not, when you do the math for those, when we pay it out, it does not match what we need to show that we've paid exactly. That's all I'm saying.
So Fred, we're also going to provide the contact information, so you may want to email that specific question so you can get a more detailed answer.
I had emailed it to Julie's office, and they sent me a bunch of stuff to read that didn't answer my question.
Okay.
Email
Yeah,
it.
make sure, I think you're giving out our information. Fred, you can go ahead and email me directly. It's just my name, julie.klaus@sba.gov.
So I can just send you what I've calculated as an example.
Yeah, we'll take this offline so we
Okay.
can work. I can work with you on your specific situation.
Okay, I'll email it to you.
And then we have one more person that had a question, and I'll sum up their questions, but Ms. Chambers, one, she wanted to know if there's funding for new businesses and grants, and if there's any specifically to women-owned and our women minority-owned businesses. Funding, grants.
So the city of Oakland is, oh, go ahead, Julie.
I was just saying, no, you're probably going to have the better, there isn't from the SBA side, but I was just going to say, you Pacific Community Ventures probably has a better angle on that question.
Sure. So City of Oakland is offering grants for newer businesses. And also, as I mentioned, the CDFI industry is large and deep. And if you're located in the Bay Area within the 9 counties, Working Solutions does startup loans. And they're still lending right now. And if you're in Oakland, particular parts of Oakland, Main Street Launch will also work with startups.
Okay, does that answer your question, Ms. Chambers?
I can type it in the chat too.
Okay. Great.
Yes, thank you.
Okay, great. Thank you. I want to thank all of our panelists. This was very informative and helpful information. We will share your contacts out because we want to make sure that small businesses have much access to capital to overcome the historic hurdles that they've had, and they can work on this bond program, because with the 25% small local participation, we need as many small firms working on this project to make that work. And it's an $800 million bond program over 5 years. So there's a lot of work out there to help them with. So with that, I wanted to say thank you. If we were all in person, everybody would give you a round of applause, but I'll give you mine for the group. And you are able to stay on. We just ask you to go on video and mute for our next conversation, part of the course, which is a great pivot, because now we will hear from Andrew Miller, who is the VP of Financial Services with oversight over accounting, tax, and CFO services at the Advitis. Prior to this position, he was the CFO for 10 years in retail oil and gas industry and 5 years as an auditor at one of the Big Four accounting firms. Andrew is joining us from the great state of Montana today. Thank goodness for virtual opportunities. We can get him here. But we also he's also going to go over, once you have this money and you're profitable after the pandemic, during the pandemic, like Tom said, some businesses are doing well during this time. How do you manage that? So next up is Andrew.
Well, thank you. Thank you very much, Shonda. I appreciate the opportunity to be here and
speak with everyone, and also enjoyed the panelists earlier. So I have a short window, and I put together way too many slides. So I do apologize in advance, but I probably will be requesting you to flip through these relatively quick. But I do want to talk about managing profitability and specifically cash flows. You know, I think Kevin said it earlier pretty well. You really have to have your financial house in order. You have to have your accounting records in order, and that's one of the things that we really try to do at Vitas Group. It's a company that helps businesses manage all of their back office functions, from accounting and payroll and recruiting, marketing, tax, just kind of all this stuff that a lot of people don't really feel like dealing with. That's what we want to try to help business owners out with, so they can focus on their day-to-day and growing their business. But so as we go into this, again, I put together way too many slides, so I apologize. I'll probably talk a little bit more conceptually rather than some of the details on these, but we can go ahead and show the next slide there and talk about a few things, one of which is, you know, what are some of the techniques that can improve your cash flows, and tools like cash flow projections, some tips for automating, you know, payments that you make and payments that you receive, cash flow ins and outs. I think, again, Kevin had a pretty good comment earlier. I caught part of it. It was something about if your outgoes are exceeding your income, then it's the downflow to your upstart. Or I might have to ask Kevin what that was, but I loved it. And then
that would be the upstart of your downfall, Andrew. You had most of it.
Okay, that was close. I'm a slow learner sometimes. I love that. And so the third item will be to, you know, walk through some things that you can either coach yourself on, or a project manager on just some cash flow basics and management. Go ahead and go to the next slide, please. And I think there were a couple of questions too in the chat about whether or not this is being recorded. I believe it is, and maybe Shonda can confirm, but I believe it can be made available too. So hopefully that's true.
We're recording it, but what we do make available is the presentation, the actual
okay.
the PDF of the presentation.
Okay, perfect. All right, so again, this part one, you know, I really think that being able to forecast your cash flows and where you think you're going is extremely critical to any business, especially when you get into project-based businesses like the construction industry. I've experienced quite a few. I've been involved with quite a few construction businesses, especially back in my, you know, public accounting auditor days. But then once I got into private accounting, I was the CFO for an oil and gas company we did not do a good job of projecting cash flows. So what we would do is we would get a real ballpark estimate of what we thought it might cost to drill a well. And it was reasonable, but then what we didn't do is say, okay, here's when we're going to spend the money. Here's what we're going to spend it on, and here's how much we think these things are going to cost. We didn't take that step. We didn't project out what we thought the cash flows would be. And inevitably what happened is we were really bad at staying on budget. The budget virtually didn't exist. And so we would end up overspending on a bunch of projects, and it pretty much ran us out of business. And it was a reason I ended up leaving the company, is I just had disagreements with management about how we were doing our cash flows and the fact that we really weren't. And so what I want to do again in this presentation is provide some small steps that you can take to try to prevent something like that from occurring, because keeping track of your cash flows is something that can really make a difference between a successful and a failed business. We'll go ahead and go to the next, please. All right, so I want to walk through doing a cash flow projection, and depending on what type of software program you're your business may use, if any. You know, I really encourage you to research what tools might be available, because even if you're using something, you know, fairly simple like QuickBooks, they do have some tools within it that come out of the box that can help you with cash flow reporting to show, you know, historically what has been going on, and then help you with putting together some projections. You know, I reference on this slide a template. It's on the next slide, but I don't actually have it available for you, but, you know, could potentially be made available afterwards. So we can go ahead and look at that on the next slide, please. All right, so I apologize, it's a little fuzzy on my end, but really what this is showing is, you know, a cash flow report. I just went out a few months so we can see it. Typically, I try to work with businesses to get them to project out their cash flows for at least the next 12 months. And a good way to try and do this from the start is look at what have you done historically, and then help build in some assumptions about where you want to go. But there's three main categories of a standard cash flow statement, which are your operating activities, your investing activities, and your financing activities. So, you know, operating is, you know, where are you generating your revenue and your sales? It's minus your cost of goods sold and payroll expenses, things like that. Investing activities are, you know, did you buy a vehicle? Did you buy some equipment? Things like that. And then financing are, you know, did you do any sort of stock offerings, long-term debt, things like that. So the next few slides kind of walk through this in more detail, but just because of where we're at with time, I'll probably skip forward a little bit. What this is saying, before we move though, I'm sorry, is there a way to go back? I'll stay on this and just kind of walk through this so you can see this slide. But really this is saying, okay, each month we started in January with $550,000. We had this various activity, and this can be either what we think is going to happen or what did happen. Let's say we think this is going to happen. So we would project out that we're starting with that cash at the beginning of the year. We think we're going to generate $100,000 in project income during the month. We're going to pay some vendors. We're going to pay some payroll. We have some interest on some debt that we pay, things like that, and basically walks down and say, okay, from operating activities, we're going to have a inflow of $45,000. And then we get down to investing activities. We purchase a truck, and then we sold a bulldozer. And I apologize that the truck purchase should actually be in red as a negative. So that's a net $25,000 of money that went out of our bank accounts in the month of January. And then in the financing section, we sold some stock. So that's a source inflow of cash. So we received $100,000 or $200,000. But then we had a lease payment on a building. We paid some dividends to shareholders. So net financing activities was a source of $50,000 into our bank. So when you net all that activity in the month of January, we are projecting that we're going to get $70,000. So the importance of something like this, and you don't have to categorize it this way. This is just the way most, you know, accounting reports would work for cash flows. You can make it a little simpler and whatever makes sense to you on how you want to put this together. But the point of this is that if you can get a decent idea of how you're going to spend your money and how you're going to receive your money, and then when it's likely to occur, this type of thing can tell you when you might run into trouble. So again, in this example, there's a lot of cash in the bank, so this business wouldn't necessarily be in trouble. But let's say you started off with $50,000 instead of $550 in January. What that means is that when we get into the month of March at the end, you know, we're pretty slim. Like we're going to be pretty close to where we need some more capital, or we might have to make a different business decision. Maybe we don't purchase another truck in March. So just projecting out where you're at and where you think you're going, and then really comparing this stuff, the actual results to what you think you budgeted here is what's going to be key to determining business decisions and being smart with your money. So we can probably go ahead and skip forward quite a few slides here, because I talked through kind of this thing for quite a few here. Yeah, keep going. Yeah, I think we can go all the way to where it starts on part. Yep, here you go. So part 2, whoops, back a couple, one more. All right, so the second part that I want to talk about is automating your invoicing and your payments. So these are, you know, your sources and uses of cash, inflows and outflows. If at all possible, try to automate these processes. Use software to whatever level you can. Even simple programs like QuickBooks can help you automate so much of this. And there's programs there's applications that can plug into programs like QuickBooks. There's a program called Bill.com that really helps you automate your vendor payment process to where you can do it all electronically. You can do it from your phone, and you can set up different approval processes and timing of payments. It just really makes it a lot simpler. And the thing I like to tell business owners is that when you're working on invoicing your customers, really try to get those invoices out as timely as you can and collect as quick as you can, because like I put on here, cash is king. So really try to get the money in the door as quick as you can. And then on payments that go out, try to delay those as long as possible and set up different terms and work with your vendors to try to extend out when they need to be paid, and just try to give yourself as much of a competitive advantage as you can to be successful, especially when we're dealing in an environment like we are these days and all the challenges that come with it. We can go to the next slide, please. So here's some best practices on invoicing your customers. Again, do it as timely as possible. You know, with most systems, you can set up automatic reminders of when you need to invoice. This automating this helps you reduce errors, and you can set up templates that make it very simple, where you're not having to manually enter a bunch of information. A good example is I have a contractor I work with that mows lawns, and he hand writes all of his invoices, and I like when I see that, the instant thought is he had to sit down and he had to write out his address and his name and all this stuff every single time, where if he just had a really simple tool, he wouldn't have to do any of that. All he'd have to plug in is the amount, and he's done. So just things like that, just save yourself some time and effort. If you can, attach the support you need, provide any notes that might be necessary. Look at what types of payments you will accept. Accept any type of payments you can. Credit card, you're gonna pay a little bit on the credit card fees, but typically you get paid sooner. ACH transfers, wires, whatever it is, just get creative. Venmo. I mean, there's all sorts of payment applications out there that can help you get money in the door. Go to the next slide, please. And then regarding payments that you make out, again, try to simplify the process by automating it with tools such as Bill.com that I mentioned before. Improve your organization and file management. I mean, just the way you name your payments and your invoices that you receive in, and maintain good, solid communication with your suppliers and your vendors. And if you're trying to automate processes, let them know. They typically will try to help out. Go after early payment discounts. If you don't want to try to stretch out your terms, then if you're going to pay early, at least get a discount for it. And you know, at least that way you're saving yourself a little bit of cash. And then if you get into some more advanced systems and your business is growing, you can try to work on developing some KPIs or key performance indicators on, you know, how much does your average invoice cost? How many days does it take to pay, and things like that. And it really does help you manage your cash flows. Next slide, please. All right, so these next few slides kind of go through some just best practices for cash flow basics. And again, one thing that I have seen that's pretty successful in the construction industry is if you have a project manager that's helping with most of your work. I mean, I'm sure a business owner would be heavily involved as well, but incentivize them. If they have a way to track, and if you can track either the profitability of jobs or the timeliness of cash collections and things like that, being under budget, whatever it is, you can put together some sort of incentive package where they get the benefit of doing a good job. If they're just not like on salary or whatever, there's a lot of creative ways you could come up with solutions to really incentivize those managers to do a good job managing your cash. Next slide, please. So again, I sort of talked about this a little bit easier, but unless you're getting a pretty big discount, don't use cash to buy your supplies and materials. Try to finance these things, because then that spreads out when the actual cash has to come out of your bank. You know, we have a lot of people on the webinar that are in this industry, so they can appreciate that. But keep in mind that you might have finance and interest charges. But again, if you're in a cash crunch, you're not out of pocket on those things. And hopefully it can help you grow and get through those leaner times. Next slide, please. Again, make sure that you're shopping for the best prices. You might have one supplier that you're typically used to dealing with, and that's great. I'm an advocate for building long-term relationships, but don't be afraid to test the waters occasionally and see if somebody down the road might have better deals, because you could then go to your supplier that you're normally accustomed to dealing with and negotiate with them. And just save yourself a little bit of money. So don't be afraid to spend a little extra time seeing if there might be better deals out there. Next, please. So this one is in connection with payroll. I won't go too much into it, but you know, sometimes you can work with subcontractors to save yourself a little bit of money on payroll. But keep in mind that it's not always the best practice, and sometimes your long-term employees, they'll do a better job for you work-wise. It's not always true, but just know there's pros and cons to that. Next slide, please. So obviously the construction world has a lot of change orders, and you know, I think the message here is, if there are, process them quickly. It's always easier to have that type of discussion with the client if you have a project that you know, needed some additional resources, something changed, whatever it is. Don't let that sit for months. If there's an additional spend that's required to get the job done, have those conversations and process those change orders as quickly as you can. Next, please. Yeah, and so, yeah, so the next one, please. Sorry, I think it clicked back. So the next one's on, you know, over and under billing. The key here is try to manage your billing as smoothly as you can, and really do send out your invoices as you're completing work. and that'll prevent you from getting into a situation where you're either over or under billing, which can throw off your projected cash flows. Next, please. This one, you know, this is pretty granular, but you can set a goal for days of sales outstanding, and again, this increases the potential cash inflows. Typically, construction industry businesses get paid between 2 and 3 months. I really push companies in this industry to try to get it down to about 1.5 months to, you know, less than 2 months. And again, this is based on following a lot of the procedures that were discussed earlier, and you know, getting those invoices out the door, providing incentives, accepting payments in any manner that you can. Next, please. So again, I think the bottom line here is that construction companies are, again, they're so project-based that cash flow is critical, and you really have to do everything you can to maximize your inflows and spread out the outflows of your cash, and just really try to work with a team that's incentivized, is paying attention, is utilizing tools that should be available to automate processes, and just really capitalize on all the resources that are out there, and hopefully it'll lead your business to a more successful path. I think that might be it.
Well, thank you, Andrew, for that.
Yes, thank you.
We will have the information available on the website.